And the surging Omicron variant hasn't put much of a damper on the roaring economy and stock markets. When the final numbers are in, analysts expect the U.S. economy to have grown at more than 5% in 2021. Meanwhile, stock markets have delivered robust performance as the economy has rebounded from the depths of the pandemic recession. Dow Jones is up over 20%, the S&P 500 almost 30% to date, and the tech-heavy NASDAQ more than 24%. But inflation has risen to its highest level in decades and supply chain issues persist. So just what can we expect from the economy and the markets in 2022? Joining us to share their insights are Michael Miller, Associate Professor of Economics at DePaul University, Michael Stritch, Chief Investment Officer at BMO Wealth Management, and Preston Caldwell, Head of Economics and Equity Analyst at Morningstar Equity Research. Gentlemen, thank you all for being here. So we mentioned these mixed signals at the top. Mike Miller, will all of these factors continue deep into 2022?
Well, that's one of the big questions. We know that we are roughly at full employment, which is great, and we're creating jobs at a rate which will keep that full employment rate for all of next year as far as it appears. GDP is growing near its potential. Actually, it's above potential, so that's good to hear. But the one problem, of course, is inflation. And the issue there is exactly how the Fed will respond in terms of how quickly and how forcefully. And will they use just changes in their portfolio, or will they use changes in interest rates?
All right, well, let's stick with that issue of inflation. Preston Caldwell, how do you think the Fed will respond in 2022?
Well, I think it's clear the Fed is going to proceed with a course correction. You know, earlier they were saying that the inflation was purely transitory, which meant that they did not need to hike rates. I do think that inflation is still to a great degree transitory, but as Mike mentioned, there are structural factors indicating that the economy is starting to tighten, run against its capacity a bit, and that augurs for a rate hike in several rate hikes in 2022 and 2023, even with these supply chain issues that are causing much of the inflation today being resolved.
So perhaps action to prevent against an overheated economy. Michael Stritch, the other X factor here is the Omicron variant, record-setting case numbers. Could that put a damper on the roaring economy?
Yeah, I think definitely at the margin, at a minimum. You know, what we like to look for there is not necessarily case numbers and things like that, but specifically kind of these real-time indicators as to the behavior of citizens around the country. And to date, we've seen some subtle declines in some of this data. I'm thinking of things like reservations at restaurants. We have a lot of survey data on traffic into retail centers and storefronts. Those maintain pretty robust levels, but I said we do have some slippage at the margin, so we'll have to see how the next few weeks play out. I think it probably will dent Q1 at a minimum, but as of right now, we don't think it's going to be a big headwind for the remainder of 2022.
And Mike Miller, as we mentioned at the top, the markets are performing exceptionally well. As we said, the Dow up about 30%, 20%, S&P 30%, NASDAQ 22%. Is this a case of the recovery disproportionately impacting the wealthy or those of means, or are we seeing the same kind of growth in wages among the lower and middle classes?
Well, when you look at it through the eyes of wealth, which versus your liabilities, the people at the top are doing better because they tend to invest in more risky investments, and those give you the higher rate of return. But at the bottom, when you look at income, there's no doubt that the people at the bottom have been given more market power in the labor market than they've ever had in the past 25 or 30 years, where they're able to negotiate in some sense. I'm not coming to work for you unless you pay me something that is decent. And because of that, we see the wages at the bottom as they were right before the pandemic. We had the largest increases in wages for the bottom that we had ever seen. And I think we're seeing some of that coming back. And that's good for the economy. And in my mind, it's not going to be inflationary because their productivity justifies this higher wage. Their wages have not quite kept up with productivity over time. And so when they finally get their cut of the pie, this is a good thing. It's good for everybody.
Preston Caldwell, how much of this is driven by the massive amounts of government investment into the economy, the just passed infrastructure bill, the COVID relief efforts, and could things taper off a bit without that kind of federal investment?
Yeah, I think we will see an attenuation of many of the trends that we see today in terms of, the high rate of turnover in the labor market and, the labor force participation rate still being below pre-pandemic levels. It's certainly true that we had the largest fiscal response in U.S. peacetime history during the pandemic, which, if you're going to err on any side, I think you do want to err on the side of overdoing it. So, even if that did have some overheating effects on the economy, I think it was, overall a good thing considering all the risks that were involved during the pandemic. We didn't have a repeat of even the Great Recession, much less a Great Depression-sized event. And so we're looking at a much quicker economic recovery this time around. And yes, I think as the the effects of perhaps the stimulus checks and unemployment benefits and so on wear off, then we'll see a normalization of perhaps some of the areas which are worst overheating right now.
A very Keynesian type of response over the last couple of years. Michael Stritch, Chicago has seen some of that federal largesse, although its growth is lagging a little bit behind the national average. Do you expect that to be the case in 2022?
Yeah, I think so. If you look back over the last 10 years or so, it's been true to form in most instances that Chicago has lagged just behind kind of the national levels of growth. And that's likely to persist into 2022 if, for one primary reason, back to the COVID situation and its impact on hospitality and leisure and convention centers in particular, which Chicago is one of the leading convention destinations in the country. That hasn't come back really to any significant means so far, and it's looking pretty, pretty tough going for that area into 2022 as well. So if I think about the overall picture for the U.S. is, again, as Mike said, above trend growth for 22, I think Chicago comes in just below that, in particular because of the sort of extraordinary leisure and hospitality and convention exposure that we have relative to some other areas of the country.
All right, Michael Miller, we referred to the so-called great resignation earlier, people quitting, employers not being able to fill their jobs. What's really going on here, and do you think these trends are going to continue in 2022?
Well, I think we're in the midst of a fundamental change of the negotiating, so to speak, between the employer and the employee. And we also have the baby boom, of which I'm a member, that are beginning to retire. That was going to happen with or without the pandemic. We were going to have some kind of a change in the fundamental nature of the labor force. So I think it's going to be just like working remotely has become much more common. I think this negotiating between workers and businesses will continue, and we will never go back to the way it was in the past. There will not be the same kind of employment, for example, within office buildings with different small restaurants and stores, because people will be working from different locations. And so the labor market going forward, I think it's quite vibrant and quite exciting to be watching this fundamental change in labor relations between employers and employees.
Preston Caldwell, how is this going to iron out? I mean, will the skills match the jobs available? What do you see happening in that front?
Yeah, a few points. I think the great resignation term is a bit of a misnomer. Instead, we're really seeing a great reshuffling. That is, most of the people that are quitting right now are hopping to another job. They're not leaving the workforce entirely. And so that opportunity to move to another job, to get a raise, most likely is contributing to a lot of the tightness in the labor market and the wage pressures that we're seeing. Although I will say, for all the talk of wage pressures, as Mike alluded to, I mean, most of the wage pressure we're seeing is on the bottom end of the spectrum, the labor market, especially industries like leisure and hospitality as they reopen. In terms of broad real wage increases, they've been fairly muted over the entire course of the pandemic. And so I don't think we should overstate that issue too much.
All right.
And I think, sorry, go ahead.
Sorry, we're going to have to leave it there. A lot to watch for in 2022, but we thank you all for your expertise. Our thanks to Michael Stritch, Preston Caldwell, and Michael Miller. Thanks so much for joining us.
My pleasure.